I have recently spoken to someone who is an former employee of the three major credit bureaus. They have worked for Experian, Equifax, and TransUnion. And they revealed to me some secrets that the credit bureaus do not want you to know. Now, I'm going to give you guys a trigger warning because some of these things you're being judged by seems very discriminatory. And I can guarantee you fit in one of these categories or more. But understand that credit is an algorithm based off your behavior. So I am giving you these secrets so you know how to change your behavior accordingly so you can get more approvals. So make sure you stick around for this whole video because we're going to reveal these secrets. Now, if you're new to my channel is designed to help you no matter where you are in your credit journey. So if you like that kind of information, make sure you subscribe to this channel and give this video a thumbs up. Also hit your notification bell so you can get notified anytime I upload a new video. And in 2023, we're going to teach you how to leverage your credit to gain assets. Also, at my website, I give you a free hard inquiry removal package because hard inquiries can get you denied for credit. I'll also have other packages for purchase to remove your negative items. And if you need my help, personal coaching one-on-one, I also have that option so you can sign up. Now, I always leave all these links in the description of my video and in the pinned comment section. So let's jump into this information. Now, in order to understand how they're judging you, meaning the big three credit bureaus, Experian, Equifax, and TransUnion, you must understand that they are not government agencies as the name bureaus will lead you to believe. These are private for-profit corporations, and they are governed by federal laws. And the federal law is the FCRA, the Fair Credit Reporting Act. Now, with these companies, they make billions of dollars every year, and they have a lot of influence in Washington. And this is why you see some of these violations, or a large portion of these violations, that they actually are breaking laws. They're not really being penalized. But one thing you need to know about these bureaus, they're in the business of selling data. That is what they make billions of dollars off of. And they have customers. Their customers are landlords, employees, but most importantly, banks. So what banks actually need to survive is customers, and they have different types of financial products to make money off of these products, such as insurance products. But most banks make more, and the majority of their money off of interest. Now, with banks, they actually make very little money off of their annual fees. Interest is their driving core business of lending you money, collecting, and making a profit off of the interest. So with the credit bureaus, little do you know, they collect all your data and then they sell this information primarily to banks and lenders, because with banks, since they make most of their money off of interest, they have different financial products in different ranges for different people and customer profiles and credit types. So what the dirty secret is, the reason why the credit bureaus are really resistant for taking negative information off your credit profile is because they get paid more for subprime credit, meaning bad credit scores, because the more bad information, the more the banks can justify charging you more in interest. So for just an example, if you're a person with subprime credit and you go for a subprime credit card, they may only give you a $300 line of credit and charge you 29.9% interest or even 34% interest, and they justify it by your credit profile. And the bureaus get paid more for those profiles because people with good credit to the banks, they can't charge them as much interest. There's not a lot of justification. This is why 70% of credit profiles have incorrect information. And they usually are where it's going to be, not even usually, it's going to be on the negative side. And that is by design. You never see the pendulum swing the other way where they mess up and give somebody good credit, because they get paid to keep negative stuff and to report negative things on you, because they can sell that profile and get paid more from the banks. So that is part of their whole business makeup. Them and the banks, them and also collection agencies, and all of these people are their customers and they're in bed together. You are not their customer, you are their product. That's why they don't care about you. They don't want to remove your negative information, and they try not to process your dispute. Now that you understand that the banks make their money primarily off of interest, this is why with the credit bureaus, I give you guys this top secret. If you're under a 700 credit score, you can increase your credit score by 50 points on average by getting a new credit card without removing one negative item. Because credit cards is an opportunity for banks to make money off of interest. That account never closes. It's a revolving credit account. This is why instead of an installment account like a car loan, if you ever had a car loan and you paid it off and you thought, oh, soon as I pay this off, my credit score should skyrocket, you're surprised when you actually see your score go down. The reason why your score goes down, because now the banks don't have that opportunity anymore with that clothesline to make interest off of you. Remember, credit is golden handcuffs. That's why I try to teach you guys to build your name, leverage your name, to leverage that debt to make you money, not you being a slave to the system. So with credit cards, understand payment history with how you pay your payments in the past is 35% of your credit score. Utilization, which is available credit to the debt, available credit to debt is 30% of your credit score. Those are the biggest chunks. That makes up 65% of your credit score. Why is utilization, debt to available credit, unsecured lines of credit so important? Because banks make money off of interest. So they love credit cards. That's what fuels the system. So if you're a person, I always tell you, if you have a lot of debt, but not a lot of available line of credit, it brings your credit score down. And you have to know how to pay your credit cards on that timing to control your utilization. This is why I tell you guys, Credit is just an algorithm based off of your financial behavior, and why I teach credit education here. A credit repair company cannot fix your behavior. Only you can fix your behavior. So if you don't know these things and how to avoid that pitfall and why utilization is so important, you're missing the whole credit game. So you have to learn how to manage your utilization and understand that behind the credit bureaus, the driving force of your approvals is interest, how you manage unsecured lines of credit that is not secured with a asset. So if a lot of people, what is an unsecured? It's a line of credit off of your credit worthiness, an approval off of your good name. Understand, a car or a home, these are secured lines of credit. The banks actually have something to go after to recoup on their money. But when they're giving you credit cards, they can't recoup off of that $25,000 if you default on that credit card. They have to pursue you. This is why credit card lines are a big driving factor to your credit score. Now, one of the top secret ways that they are judging you is by your address. Your address plays a huge part on your approvals and how much you're being approved for. So understand, every credit profile, you have your street address, and behind the scenes, they are getting information from another CRA, which is a credit reporting agency such as LexisNexis, which in that area, they are judging the income of the average person that lives in that area. They are looking at also the average credit score in that area and how many number of bankruptcies are filed in that area. So if you're a person living in a lower income area and you may have an 800 credit score, a person that's living in a more affluent area may have a 680 credit score, and you may be only approved for a $10,000 credit card, where that person, because they live at another address, will get approved for a $25,000 credit card, because they are collecting this data in the background, and your address determine your approvals. Also, your addresses that you have connected to your credit profile is important and is your determining factor, because understand, the bureaus have to create all of these profiles and try to identify people. So one of your personal identifiers is your past addresses, and they are very resistant to removing old addresses, because imagine, like me, my name is Sherry Beckley. There are tons of people in the United States with that same name, but with that address of where I lived in the past, they try to add these things on your credit profile. For instance, Equifax, they keep a ton of old addresses. That's because if you had a collection at that old address or a charge off, that's how they seek that address and that charge off to you, because it's collected and it was created at that prior address that you lived at. So it's important, before you start disputing any items, you want to remove your old addresses, because this is how they connect that data to you. So your addresses is a big deciding factor. They also look at how often do you move. So a ton of old addresses make you look like you're not stable, that you're constantly moving. And so that is an important factor that they judge you for approvals. Another secret way that they judge you is you being a homeowner or a renter. Now, the reason why this plays a factor with a person that owns a home, they understand you went through a bank and went through a stringent process of being approved for that home loan. So they understand, with that being on your credit profile or you owning your home, you are a more responsible person versus a person that rents. So they look at a person that rents that actually doesn't have anything of value. So remember, if you ever forfeit on a personal loan or a credit card, the banks themselves have an asset to pursue after. If you are a homeowner, when you have LexisNexis, and if you ever go to their website and request their credit reports, they also have your home values there. So that is working in the background along with these credit bureaus to see that this person is a homeowner and their mortgage was $200,000, but right now their home value is $500,000. So a person like that will get approved maybe for larger amounts of credit because the banks know they have something to pursue. A person that's a homeowner is going to be more responsible because they have something to lose. A person that is a renter does not have anything to pursue. Also, it says something about your mindset. When they look at your credit profile and you're a homeowner, you look like a more responsible person interested in investing in your future. Understand, I tell you guys all the time, your credit is attached to your character. This is why they say your credit worthiness. Are you worthy of credit by your character? These companies don't know you personally. They only know you by your financial behavior. So you want to be wise on how you're building your credit profile. And this is why real estate accounts hold a lot of weight. Another top secret that they're judging you by is your age. So this pendulum can swing both ways. A person that's really young, they feel like you're not trustworthy a lot of times to handle a lot of credit because they don't have enough data. This is why age of credit is very important, and it's 15% of your credit score. So you want to have longer credit history. Age of credit is important to see where they could trust you. What have you done in the past? How old are your credit lines? Because going back, they want opportunities to make interest off of you. Also, being older can also count against you. If you're a person in your 70s or 80s, they do have actuaries to know this person life expectancy is not the same of a 30-year-old. So many of times they want to pull back on how much they actually extend credit to people as they get older in age. So that can play a factor, and that's one of the top secrets. Another top secret ways that they're judging you is types of employment. So a person that is an employee has a better chance than a self-employed person of getting approvals with larger lines because the banking system is archaic and they go off of data. They want the sure thing. They know if a person is employed as a W-2 employee, they can garnish that, person's income with that employer. So they're far more secure with that than a self-employed person, or even if you are a business. applying for credit. They look at self-employed people and businesses with a lot of scrutiny. And so when you put that on your application or even on your credit report, a lot of times if you're self-employed, you're going to get extended less credit than someone who is employed. Also, with the employment, what is your position in that company? So they do look at positions. So a person who is self-employed, instead of putting self-employed, if you have an LLC, you might want to say, I'm the president, I'm the vice president of the company of your LLC. Also, if you're employed, your status, this is why they ask you on these applications, what is your job title? What do you do? Because that also puts you in a different category. A CEO or a president, that is looked at more of an executive position, and there are different offers catered financial products to those type of people. So you want to be very careful what you're putting down on your application on your employment. And also, you guys, place of employment. I have a lot of y'all that, oh, they got my old employer on there, and then baby, if you're a person that's currently have a debt or a judgment, you don't want them to have your employer. Where do you think collection companies know where to garnish you? The credit bureaus are telling them, and you got your employer right there. So a lot of you guys, you got to watch what you telling to these companies. You need to learn this. Stop snitching on yourself. You need to know and be educated to know what you want to report to these people and know when and where and why you shouldn't report this stuff. A lot of this stuff that they know about you and a lot of people cry about, you're telling them. So you need to get this credit education and know, oh, if I got a judgment, I better not put that. Leave my past employer on my application. So remember, you guys, these are ways that you're being judged and watched. Another way that they're judging you is your income and types of income. So for instance, if you're applying on an application and you're looking for a personal loan and you're temporarily unemployed, so you might just be a school bus driver and you get laid off temporarily during the summers, you would want to put there that you're employed at that time, because if you are unemployed, it looks like you don't have a job. And of course, nobody wants to lend to a person who don't have a job. Another thing, retirement income. A lot of times they know people are on a fixed income or sometimes Social Security income. You might not get approved for larger lines of credit or loans. That type of income can look like you can be in a desperate situation. Sometimes they will judge that you might not can tolerate as much of a loan to pay back as someone else. So another key is how much income that you are making. Of course, the amounts of income, if you're a real high earner, that's going to dictate that you get a larger line of credit. And many times what a lot of people got to understand, DTI come into play. So how much debt you have versus your income and type of income, you guys. So a lot of people get upset with loans like, oh, I have a 700 credit score and I make, 90 grand. But if you got 60,000 worth of debt constantly, rotating annually, you cannot get a $50,000 loan the majority of time. So your income, even versus your debt, is going to be a big deciding factor and types of income is a lot of what they see. So always understand they get all this information from you. You're giving this information to the banks on the applications, that's giving it to the credit bureaus. Or when you're filling out an application for an apartment, you're kind of snitching on yourself. So you want to be aware that these are types of ways that people are judging you, and the credit system is keeping a record of this to judge you behind the scenes. Another way that they secretly judge you is your marital status, whether a person is single or married. Of course, people that are married have a higher general, most of the time, household income. Married people, if they are together, the banks, if they give that spouse a loan, you can be another person that they can come after things that you own. So marital income and marital status, a lot of times they see that at a higher status than being single, because they have another person they can kind of go after. Also, when it comes into insurance products, they look at married people as being more responsible, honestly and truthfully. When it comes down to people being married, they just feel like they won't take as much risk because they are married and have children or have obligation, and single people are more risque and they will take more risks. And also, when you want to fill out an application, even if you are living with somebody, a partnership, many a times it says household income. Use that to your advantage if it says that on an application, to bump up your income with the person that's in your household and the types of income. So if you have a spouse, if you're living with a boyfriend or girlfriend, if it says household income, you can count their income and keep putting that on your applications, and that will be recorded with the credit bureaus. So you can get larger approvals because they are secretly judging you by this in the background. Now, here's some bonus top secret information that the ex-employee for the 3 major credit bureaus gave me. They told me that the banks such as Bank of America, Chase, also Citibank, and Wells Fargo, the big 4 banks, is where the credit bureaus get 90% of their information on you. So, as I always tell you guys, this is all for educational purpose only, and none of this constitute as financial or legal advice. But what I'm telling you guys, if you're a person with a judgment and you're wondering how did they figure out where my bank account was, there you go. Because if you're connected with these banks, a lot of this information, they're reporting your stuff to the 3 major credit bureaus. So maybe if you have a judgment or a collection, I might personally may use an online web bank, or if it was me, I might use a local credit union who's not sharing all that information on me with the 3 major credit bureaus, okay, as far as my accounts. So that is a big sign, you guys. That means that when you're saying you change addresses, but if you're connected to one of those banks and your bank statements is still going to an old address, hey, maybe you should do something different. Maybe you should get a P.O. box street address with UPS store that actually give you a street address, and you can use that to dispute or to remove negative items and send your bank statements there. Because guess what? If you're connected with those banks, they're going to update the credit bureaus immediately. Also, the post office, when you're sending out mail certifieds, they report to the three major credit bureaus. When you put in a change of address when you move, they report to the major credit bureaus. So they're getting information from them on you. So know that these places are reporting you. Also, think about it. If you have a credit card on your credit profile like Navy Federal, and maybe you don't owe them money, but you owe a collection company money. By you having that credit card, they might not be reporting all your bank account and all that information on you, but because that credit card is reporting on your credit report, you have a collection, you have a judgment. They know that you have to have a bank account to be able to obtain that credit card. So that's also giving a way to track you if you guys got outstanding debts. All of these companies are reporting data on you, even down to the post office. Also, one of the employees shared with me, when you are receiving Amazon packages and all of that on Amazon, when you're using Amazon Prime, they report your addresses to the three major credit bureaus. So that's another way that they are getting information. Remember, all of these companies, in order to have access to your credit reports, even collection companies, they are required to have a subscription and report a certain amount of names every month to have access with the three major credit bureaus to get reports. This is why you see now a lot of collection companies, a lot of banks don't want to do a pay for deletion because they have a set number of names and information that they must report. And of course, that negative information, the three major credit bureaus love, because them keeping that on your credit report, they can sell that at a higher rate. So I hope all this information was helpful to you guys. If you have comments, you can leave them in the comment section, or if you have personal questions for me that's more detailed, you can go to my website, and at my website all your questions go directly to my cell phone. And I hope to see you guys in the next video. Stay tuned.